Here with Bradley Duke from Night Direct here at London's Trade Tech. Bradley, thanks ever so much for taking time away from the show to talk to Automated Trader.
No problem at all, it's a pleasure.
You've had some news out yourselves this week. There's been a release of a new algo, which you've been very vocal about.
Yes, we have launched our new algorithm for Europe called Oasis. It's an algorithm that's really defines its own category. It's in that it's the first time an algorithm specifically designed for trading small and mid-cap names has been developed. So it was launched in Europe. It has already been. We already had a soft launch a few months ago, so we've had a few trial clients who've been using it, and in Europe. 6 months ago it was launched in the US officially, and the reception has been tremendous.
Okay, what's the algorithm designed to do? You say it's designed to trade small and mid-cap stocks, but,
yes.
But could you give us a little more detail on that?
Yeah, absolutely. Well, the problem, small and mid-cap or thinly traded stocks is trading thinly traded stocks is a challenge for all market participants. Whether you're the sell side or the buy side, it's always going to be a problem to trade thinly traded stocks in that the spreads are wide. As soon as you start trading, your impact is felt really disproportionately to how it would be in a more heavily traded stock. And there's also it's an environment that's fraught with danger, because when a stock is more thinly traded, the opportunities for gaming by other participants are easier. So that's taken into account in the way the algorithm was developed. There's a lot of anti-gaming logic developed into the algo, and it really trades the way a very, very good trader, very good and diligent and focused trader would trade a thinly traded stock. In that it never, for example, removes the price entirely, causing a new price point, and it doesn't have to finish. So there's no time imperative that it can push the price up or down depending on if you're buying or selling. It's also very mindful of the most common gaming tactics that other participants may engage in.
Okay, and how many venues will the algorithm go off to in order to achieve its objectives?
Well, that's a very good question, because underlying Oasis is the fan technology that underlies all our other algorithms, and that's liquidity sourcing technology. So when the decision is made to actually to trade, we will look and aggregate our liquidity, the liquidity that all actionable liquidity that we have access to obviously to increase the likelihood of being executed in the first place, lower, raise the likelihood of getting some price improvement, and reduce impact. So if we can get executed in the dark for any part of your order, we'll always take that option. And it's also, the algorithm is opportunistic in that if it does come across a nice block of liquidity at a certain price point, then
it will continue to feed off of that.
It will just take it, and because it knows that that's going to be a trade that's done with low impact, and that's going to be favourable to the overall results and the slippage.
Very good.
Yeah.
What sort of benchmarking have you been able to do so far, or what sort of feedback have you had from the beta testers?
Right. Well, the clients have been very positive. Very. I think it's great news for a lot of people who do trade thinly traded stocks, because the thinly traded names are the ones that are most likely to really bring them down. So say if they're trading a portfolio, that the thinly traded names on the edge of the portfolio are the ones that will really bring down the overall performance of the fund or of the portfolio, because obviously the big names that are traded, the more heavily traded stocks, the spreads are very tight. If you have to cross the spread to get executed, it's not the end of the world. But with the thinly traded names, that it really is much more challenging, and crossing the spread means a significant impact on the slippage.
The addition of Oasis that adds exactly what to your suite of algorithms?
Well, it really rounds off the suite. I mean, I'm not saying that it's the last algorithm that we'll develop, because we engage with our client base to get feedback from them for things that they're looking for. And this is actually was the genesis of Oasis. Clients really spoke to us and asked us, said that this is really a problem for them, and it'd be great to have something that could help them solve this problem. So it's another, if you will, another sort of arrow in
the quill.
Quill, exactly.
Sure.
And so that when you're faced with that particular trading problem, this will be the algorithm for you. And that's, we see ourselves as execution consultants, because it's really about understanding what the algorithm does and in which situations would it best be applied, and which algorithms, because it is dangerous to use an algorithm in the wrong situation, so we really like to make sure that our clients understand the algorithms and how they work, before they use them. Okay.
Couple of questions about the market in general.
Yes.
How have you been seeing? Have you been seeing volumes and liquidity in general? What is the general trading environment like at the moment?
Well, we definitely seen more recently a big uptick in volatility. Obviously, that usually means that's coupled with higher trading volumes. There's a lot of uncertainty about where the market's going, or why it's behaving the way it is. People are a bit perplexed by when they get into the fundamentals of the market and in terms of where we are today and what and where it's going to go. We take a sort of a neutral view on the market, and that we know that people are going to be trading regardless of whether the market's going to be going up or going down, and we just want to assist them in their situation, to help generate alpha or reduce slippage, or just overall improve overall performance. As I said, we remain neutral about where it's going, and certainly from the night direct perspective. Yeah.
Okay. There's been a lot of furore recently, it seems, in the mainstream press and other areas of the media surrounding high frequency trading.
Yes.
What's Knight's view on this?
Well, certainly, Knight believes that there's a place for lots of different types of participants in the marketplace in order for the health of the overall trading environment. So
different people trading with different time horizons and different holding periods, etc.
That's exactly the point. You hit the nail on the head with different time horizons is the key to the whole high frequency discussion. You may have as you know, high frequency traders may trade in and out of a stock several times over a few seconds, whereas you may have a retail investor that wants to buy and hold for a period of years. So the truth is that there actually isn't, on a particular trade, there isn't actually a winner and a loser on that trade. That's simplistic to say that, oh well, it's a zero-sum game. If someone's winning on this side, then somebody's losing somewhere else. If your time horizons are vastly different, it doesn't make any difference at all. The retail investor may sell a position that's accumulated, say, 120% value over the last 5 years, is not too concerned about 0.5% that may be the difference between what they're getting, or if somebody else had beat them to a price that was 0.5% better. They're more focused because their time horizon's long and they've seen an appreciation. It's neither here nor there. But whereas the high frequency traders, that's the whole basis of their model, is
capturing raison d'etre.
Exactly, it's capturing those little fractions of a penny here and there, and that's how they accumulate their their profits. And
that doesn't need to disadvantage the longer term investor.
Absolutely not. And plus, we've all seen that with the entry of increase in the US, the high frequency traders, the electronic liquidity providers into the marketplace, that overall trading volumes, overall liquidity has grown tremendously. And
what's been the effect of that?
Well, it means tighter spreads. It means it's a more favourable trading environment, and definitely helps the the retail trader. I think that today the retail trader is facing a trading environment that's the most favorable that's ever existed. You know, they can get great prices. There's a lot of liquidity at their price point, and you know, far from, it's definitely not a situation where they are suffering, you know, at the hands of some malicious and, you know, high frequency you know, trading model.
Bradley, thank you ever so much for taking the time to talk to us today.
Thank you very much.